Right then, good afternoon, folks, and just another update from us at the end of another week of trading. Pretty dire week of trading, pretty boring week of trading across the board, across many of the different assets and asset classes. But we will have a look. I'll have a look through the different asset classes and see what we can find. We started the week on Monday with no high impact data across into Tuesday. A couple of things out of note on Tuesday. The minutes out of Australia where they went on pause at their last meeting. The latest central bank to draw to join the group of central banks pausing and beginning to pause, and yeah, largely stuck to the script with that. Said they were going to be data dependent going forward. They're going to look at local data, overseas data, in order to decide what they are going to do in the future. They said growth is predicted to be below trend, below what they would expect for the next couple of years, and that's pretty in line with all the rest of the central banks. So kind of data dependent going forward. Just going to play it by ear, and they did mention that they went on pause in order to allow for policy lags, and allow for those to catch up. Obviously, when you raise interest rates, the effects of that does not take place straight away. So you got to give it a bit of time for those interest rates to take effect, rather than just hiking these economies into recession. Into GDP figures out of China, which brought some positivity on markets on Tuesday morning. Got to the desk on Tuesday morning, and stock indexes were up, stock indexes were happy and enjoying life. Consensus of 4%, up from a previous of 2.9%. We can see an actual of 4.5%, so strong GDP growth. But once those figures were then digested over the course of the morning, if I just go back to these medium impact numbers, come back to Tuesday, see industrial production not quite where markets are expecting, a little bit of a miss on that. But if this fixed asset investment, which is investment in real estate and construction in the Chinese economy, consensus of 5.7 down to 5.1, even below the previous month. Now a lot of the wealth in China is tied up in real estate, so the fact that there's not a lot of investment into that sector put a bit of a dampener on that strong economic growth. Positive across the board though. Apart from that, retail sales strong, consumer spending, unemployment rate down, but a fixed asset investment number, investment in construction and into real estate and things like that, not too great when it comes to China, and put a bit of a dampener on markets over the course of the rest of the day, really. Into the UK, then a little bit closer to home. Claimant count change, the unemployment rate ticking up slightly. The amount of people claiming for unemployment benefits, ticking up slightly, as you can see. That brought us then into inflation, and another sticky inflation print for the UK, and the Bank of England are in a spot of bother. UK economy is in a spot of bother. Consensus 9.8, so we're expecting a big drop in the rate of inflation. The CPI print this month. Previous 10.4 down to 9.8, but still remained up in double digits. So double digit rate of inflation in the UK, still in the year over year figure. If we wind that back to the medium impact number, and we come back to the month over month CPI print, still 0.8% in the month of March, still double digit levels of inflation. Chancellor Jeremy Hunt doesn't seem to think it's that much of a big deal at the moment, but I'm going to have to disagree with that one. Double digit levels of inflation when you're raising interest rates 9-10 months in a row, or 9-10 meetings in a row, is not good. That is not good, and the Bank of England are in a spot of bother. They have to keep hiking interest rates. They have to continue hiking interest rates, and that's going to cause a further drag on the economy going forward. It's going to further tighten business conditions, and what does that lead to? Probably a recession. But I mean, if inflation remains where it is, and they have to continue to hike interest rates at an aggressive pace past what they would like to, that means that any potential recession on the way gets worse and worse with each rate hike, and this unemployment rate is a large component of that. The jobs market is still hot, the labour market is still strong, and although people won't want to become unemployed, I don't think the government or the Bank of England will be too happy with a rise in that unemployment rate in the coming months ahead. But that's the situation that they are in and put themselves in. So on the charts then, on the markets, and you can see across the board how ugly is that for our screen. You can see the four US indexes on top: the S&P, the Dow Jones, the Nasdaq, and the Russell, all just hacking about sideways. They are up, they are down, they are up, they are down, and there is a clear lack of clear direction. You can come across to the DAX, and the DAX is up a little bit to start the week, down a little bit to end the week. What do you do with that? The FTSE is up, it's down, it's up and down, choppy. Nikkei choppy across the board. The VIX choppy across the board as well. What do you do with that information? I don't know. Some positivity in markets, then overtaken by some negativity in markets. Not really a lot you can do over the course of this week. And we jump into FX world, and FX world is pretty similar. You can see the Aussie, it's up and then it's down. You can see euro dollar chopping sideways. The Kiwi is kind of grinding lower at the moment with lower lows and lower highs, so that's not too bad. But cable again chopping sideways. Dollar Swiss a little bit of downside. Right, dollar Swiss a little bit of downside to kind of end the week over the course of Thursday and then into today. So it'll be interesting to see where that closes. You're through the lows here on dollar Swiss, so maybe that's one with a bit of direction for you. But certainly the dollar index not giving you too much over there. But the one bit of direction this week has come from dollar CAD. Right, clearly not a dollar move. Right, clearly not a dollar move, as we can see. If it was a dollar move, we would want to see, or not want to see, we would see this type of a move across the board on all the different US dollar currency pairs. Driven though by the downtrend in oil, which has given back all of its gains from this nearly all of its gains. From this post OPEC spike. Remember, spiked in the open a couple of weeks ago on a report that OPEC would cut oil production or cut oil supply by 1 million barrels per day. As then chopped sideways for a while. Lots of market participants thought that would rally higher, and it did make an attempt higher, but now it has started to pull back, which is natural after a move like that. You see a big spike up higher, then you get a move back lower, and that is where the clear direction over the course of this week has come from. Right, oil lower has driven dollar CAD higher. Unless you were on board with that, you've probably had a difficult trading week, but quite a commonly traded asset, so hopefully you managed to jump on board. But apart from that, not really a great deal to go off. Bond yields to start the week were higher, to end the week we are now lower, and if they keep continuing lower, they keep pushing lower, that should prove somewhat supportive for equities in the near term. But if they are pushing lower or fears of a recession, that is not positive for equity. So you gotta keep that in mind. Those bond yields pushing lower, generally seen as a positive in this day and age for equities, but equities are not moving higher. Keep that in the back of your mind as we head into next week. Alright, brings it back to next week then, back to the calendar. Not a massive amount out in the calendar next week. You got some inflation out of Australia. Doesn't make too much of a difference when it comes to the RBA. They said they are ready to act if necessary. They will act if they have to. 6.9% is the consensus versus a previous of 7.8%. Whether that plays out or not, where we come in relation to that 6.9, obviously gives us a bit of a clue. But I mean, if it's 7.2 or it's 6.5, you'd have to imagine the RBA don't even comment on that. So probably a slightly tricky print to trade over on Wednesday morning. And next week brings us into some growth figures out of the US. Now we had strong growth in China, strong growth in US, which should probably prove supportive for risk. Negative growth in the US should obviously prove negative for risk. But it's the quarter-over-quarter figure, the advanced figure, the first estimate we get of this figure. Q1 figures, but consensus is still for 2%, and that's not exactly recession signaling. Now if you go into it and have a quick look, it is down from the previous month, down a couple of months in a row, down from 3.2 to 2.6, down to 2. So growth is slowing, but you can't have 3% growth every quarter. You can't grow your economy by 12% every year. It just doesn't work like that. So 2% in terms of the quarterly figure, certainly to me anyway, does not signal a recession. Now Bank of Japan I think is an interesting one. I was listening to an interview on Bloomsbury earlier on, just on the TV over there. They were mentioning that Bank of Japan were considering ending yield curve control at some point over the course of the summer. They said it was a possibility, and that is a big step. Certainly a big step, which can be an explanation for this massive downside in Aussie yen and CAD yen now, which then is supportive for the Japanese yen, a strength in the Japanese yen, likely off the back of that commentary. So I think that's one to watch. If the Japanese do ditch yield curve control, yields will go through the roof, and that will be probably means the yen goes through the roof as well. So we'll have to see. We'll have to see again how that plays out over the course of the summer. But long Japanese yen for the next couple of months. As long as that chatter remains, it might not be a bad decision. Maybe that's the best opportunity of the year right there. Apart from that, then GDP figures, growth figures out of the Eurozone, will cross that bridge when it comes to it next week. And inflation, the Fed's preferred metric of inflation, Friday of next week, 1:30. And again, we will update at some point next week. But 0.3% consensus versus the previous 0.3%. Inflation still continues to climb. Markets need, or central banks need, to get that under control. Right, Australia pulling back, which is positive, but still 0.3% a month. That would equal to 3.6% a year, which is still above target. When they allowed it to get up to 7, 8, 9%, it's ridiculous to suggest that they will allow that to continue at that pace. So they still have work to do, central banks, but for now, inflation continues to remain sticky. But that's it for me then, folks. Let you get on with your weekend. Have a nice weekend. Do recharge the batteries. Get some rest and relaxation in, and we will be back next week for another week of trading. Thank you.